Good morning, everyone. My name is Vandana Tiwari. I am an assistant professor at IMT College of Law, and today we'll be discussing about different types of companies. So before we start, let us have a brief discussion on what a company is. So a company is nothing but an association of persons who come together to do some business in order to gain profit. So this is what is a basic definition of a company. According to the Companies Act 2013, a company is a company which is registered under the Companies Act 2013 and which has been previously registered under the Companies Act. So this is the basic idea of what a company is. As most of us must already be aware that a company is an artificial legal personality and therefore it comes with different features. But today we will be discussing one aspect of a company, that is the different types of a company. So moving forward, this is the classification table of different kinds of company. A company can be classified under the following four heads. First is according to the number of members. So based upon how many members are present in a company can be divided or classified into three parts, that is a private, a public, and a one-person company. Uh, Needless to say that I'll have an elaborate discussion on all these points later. As of now, the second kind of classification is that according to the mode of incorporation, there can be two kinds of company. One is a statutory company and second is a registered company. Then third classification can be based upon the according to the liability of the members as to what is the liability that each member holds in a company. First is a company limited by shares. Then second, a company could be limited by a guarantee. And third is that there can be an unlimited company. The fourth classification of a company is all the miscellaneous kinds of companies. For example, there can be companies which are not for profit. There can be foreign companies. There can be government companies. There can be holding and subsidiary companies. There can be associate companies, small companies, dormant company, producer company. So the list is not exhaustive. However, I've tried to incorporate the major kinds of companies in the fourth classification. So we will take up each type of company step by step. So first of all, let us discuss the kinds of companies on the basis of number of members. So the first one is a public company, the second is a private company, and a third one is the one-person company. Let us discuss a public company first of all. As you can see through the image over here, there are multiple people over here. You'll get to know why this is. So a public company, according to Section 2, Clause 71, a public company is a company which is not a private company. What an obvious definition this is. Let us understand this in a more elaborate fashion. So, under Section 2, Clause 71, a public company means a company which is not a private company. It may be formed for any lawful purposes by 7 or more persons and shall have a minimum of 3 directors in its board. A public company is required to add the words limited at the end of its name. So if you're going to incorporate a public company, make sure that the name of the company ends with the word limited at the end of the name. It is the essence of a public company that its shares and debentures can be transferable freely to the public, unlike a private company. So, in a public company, the shares can be freely transferable as they are available to the public generally. So, a lot of people also invest in stock exchange. They may be aware what a public and a private company is. So, only the shares of a public company are capable of being dealt in on a stock exchange. An important point to be mentioned over here is that a private company, which is a subsidiary of a public company, will also be considered a public company. So the parent company should be a public company. Any other company falls under the category of the public company, needless of irrespective of whatever kind it is. So since it is existent in the public domain and directly affects the public, therefore a public company is required to comply with various formalities which have been stipulated by the Companies Act 2013 and the various rules and regulations which are present thereunder. So what did we learn today? That a public company, the definition of the same has been given under Section 2, Clause 71. A public company is a company which is not a private company. Second, we learned that the shares of a public company are freely transferable. There are no restrictions as such on it. The third point that we learned that the minimum membership required is 7 members, but there is no maximum limit in the membership of a public company. A public company can invite public for the subscription of its securities, and the subsidiary of a public company will be deemed to be a public company even when the subsidiary is a private company and has those three restricting clauses in its articles of association. So these companies are required to comply with a lot of formalities and procedures as we already discussed. So this was a public company. Moving forward to the second kind of a company, that is a private company. Now, private companies are those which of whose articles of association restrict free transferability of shares. This is the basic essence of a private company. In terms of members, private companies need to have a minimum of 2 and a maximum of 200 members. These members include present and former employees who also hold shares. A private company, by its articles of association, prohibits any invitation to the public or to subscribe for any shares or debentures of the company. The private company enjoys certain exemptions and privileges, such as it is not required to file a prospectus or a statement in lieu of prospectus to the general public while inviting capital. So, although it is a private company and it cannot raise capital from the general public, but there are some benefits also of having a private company, that the number of compliances are lesser as compared to a public company. So in brief, going through the slide that I have shared, a private company is a company having a minimum share, paid up share capital, which keeps on changing, and which by its articles limits the free transferability of shares. A private company must add the word private at its name, at the end of its name. Just like we discussed in a public company, the use of the word limited was compulsory. In case of a private company, the use of the word private in its name is compulsory. It should have a minimum of 2 and a maximum of 200 members. A private company restricts the right of members to transfer its shares. It prohibits any invitation to public to subscribe to its securities. These companies enjoy certain exemptions and privileges, as we already discussed, and with the help of an example of the prospectus, that a private company is not required to issue a prospectus. Moving forward, um, let us move on to the third kind of company, that is a one-person company. So the Companies Act 2013, I must say, completely revolutionized the corporate laws in India by introducing several new concepts that did not exist previously. One-person company is also one of the new concepts which was introduced during that revolution, I would say. OPC means a company which is formed with only a single person as a member, unlike the traditional manner of having at least 2 members. The recognition of single person as a separate legal entity paves path for small traders, service providers to venture into business by expanding their opportunities through corporate identity. Section 2, Clause 62 of the Companies Act defines a one-person company as a company that has only one person to its member. The members of the company are nothing but subscribers to its memorandum of association or its shareholders. So an OPC is effectively a company that has only one shareholder as its members. Such companies are generally created when there is only one founder or promoter of the business. So the entrepreneurs whose businesses lie on early stages, they prefer to create OPCs instead of sole proprietorship business because of the several advantages that OPC offers. As I already told, an OPC is a private company. So taking a brief glance as to what an OPC is, this has been mentioned under Section 2, Clause 62 of the Companies Act 2013. And OPC means a company that has only one person who shall be a natural person as a member. It is a type of a private company only. So if you want to draw the basic classification, it is a public company and a private company, and OPC comes under the private company. It is necessary to mention the words OPC, that is one person company, in brackets below the company's name wherever the name of the OPC is mentioned, printed, engraved, or affixed. The concept of OPC, as already told, was introduced in the Companies Act 2030. So earlier, a single person could not establish a company. If an individual wanted to establish his business, he or she could opt only for sole proprietorship. The OPC status and concessions will be withdrawn if its paid up share capital exceeds 50 lakhs or average annual turnover during preceding 3 consecutive financial years exceeds 2 crore rupees. Why this has been laid down? So as to control the flow of the money. So by this we have learned that there are there are three kinds of companies on the basis of number of members. The first one was public company, second was a private company, and third one is a one person company. Moving forward, let us discuss the classification or the different types of company on the basis of the liability of members. So the three classification are: a company can be limited by shares, it can be limited by guarantee, or it can be an unlimited company. The first kind of company is a company limited by shares. So sometimes shareholders of some companies might not pay the entire value of their shares in one go. In these companies, the liabilities of members is limited to the extent of the amount which has not been paid by them on their shares. This means that in case of winding up, members will be liable to pay only up to the remaining amount of their shares. So the liability of members in a limited company is limited by the memorandum to the amount which has not been paid on shares which has been held by them. So only up to the extent of the amount which you have not paid will you be liable to pay the amount of share. This liability can be enforced at any time during the existence of the company or during the winding of the company. It is not mandatory that the value of the share will be asked from you only at the during the winding up of the company, but can also be asked during the persistence of the company, during the persistence of the business of the company. So a company limited by share is also known as a limited liability company, and therefore they are required to use the word limited at the end of the name of the company. And if shares are fully paid, the liability of the members will be nil, as we already discussed. So what we learn from this one is that a company which is limited by shares, the members of such a company are required to repay the amount or to pay the amount of the shares which have been held by them. And no member of the company can be asked for a single penny more than that. Moving forward to the second type of company, that is a company limited by guarantee. It is a registered company in which the liability of the members is limited to such amounts as they may respectively undertake by the memorandum to contribute to the assets of the company in the event of its being wound up. In case of such companies, the liabilities of its members is limited to the amount of guarantee which has been undertaken by them. So the liability of the members is limited by memorandum to the amount which has been undertaken by them, that is, which has been guaranteed by them. Such an amount as they have respectively undertaken to contribute to the assets of the company to meet the deficiency at the time of its winding up. This guarantee can be enforced only at the time of winding up and not before it. So this is different from what we read in the first kind of company, which was limited by shares. In a company limited by shares, the amount of shares can be asked at the winding up and also during the persistence of the business of the company. But in case of guarantee, the amount of guarantee can only be asked during the winding up of the company and not before it. The third point in this is that the memorandum of association of such companies state that what amount each member has guaranteed, and this amount may differ from member to member. So in case of a guarantee, it is an individual's or a member's personal liability to repay the amount, to pay the amount which he has undertaken or which he has guaranteed to pay during the winding up. The amount which they have undertaken or which they have guaranteed to pay can differ from one member to another. But in case of a shareholder, the value of each share is mostly same. If we are talking about a public company, in a private company, it may differ as per the terms and conditions of the company. So this is a major difference that we read in, in between the a company limited by a guarantee and a company limited by shares. Some examples of such type of a company, that is a company which is limited by guarantee, can be clubs, there can be trade associations, there can be research associations and societies which are which the purpose of which is to promote uh, various objects and are various examples of guarantee companies. The third kind of company, before we discuss the third kind of company, it is important for me to mention over here that it is not necessary that a company will exclusively be a company limited by shares or will exclusively be a company limited by guarantee. It can be both. A company can be both limited by a guarantee and can be limited by the shares at the same time. It will depend upon the proportion of which they are offering. So such companies may or may not have share capital. If it has share capital, the liability of the members will be twofold. That is, they are liable for the amount remaining unpaid on shares as well as the amount payable under guarantee. So what will happen is that the amount of shares that they have purchased, that is the number of shares that they have purchased, they will be liable to pay that amount. Other than that, if they have guaranteed certain sum of money or whatever they have promised to pay during the winding up of the company, that they are liable to pay also as well. This is the third kind of company, that is an unlimited company. So a company which is not having a limit on the liability of its members is termed as an unlimited company. In case of such a company, every member is liable for the debts of the company as in an ordinary partnership in proportion to his interest in the company. Now, there we have already, it is mostly it is told that there can be different forms of organizations. One of such form of organization is a company. What is different between a company and any other form of organization is that the concept of liability. So the most attractive factor in a company is that it has limited liability, and this third category of company differs from that. So a company can use all personal assets of a shareholder to meet its debts while winding up. Their liabilities will extend to the company's entire debt. This is different, and I don't think this is much in vogue, especially in India. A lot of companies opt only for limited liability and not for unlimited liability, because then they lose the most attractive feature of a company, that is of a limited liability. So such companies have no limit on the liability of its members. That is, their liability may extend to their personal property to pay off the liabilities of the company. The memorandum of such company must state that the liability of its members is unlimited. Liabilities of members is enforceable only at the time of winding up. Every member is liable to contribute in the proportion of his interest in the company. I personally feel this is not the most sought after form of company, but since from the education point of view, we always read it, and I wouldn't say that there aren't any companies with unlimited liabilities. There are. So this was the second basis of differentiating between three different kinds of companies, that is on the basis of the liability of the members. We discussed there can be a company limited by shares. Then we discussed that there can be a company limited by guarantee. We also discussed that there can be company which is limited both by shares and guarantee. And third, we discussed that there can be unlimited company. Moving forward, the company can also be classified on the basis of the mode of its incorporation. The first one is a statutory company and the second one is a registered company. First of all, let's talk about statutory company. Now, a company may be incorporated by means of a special act of parliament or any state legislature. Such companies are called statutory companies. Instances of statutory companies in India are RBI, that is the Reserve Bank of India, LIC, that is the Life Insurance Corporation of India, the Food Corporation of India, that is FCI. So all these are examples of companies which are statutory companies because they have come not after being registered under the Companies Act, but they have been incorporated by statute, that is by the action of law, that is by the act of the Parliament. So this is the first kind of company. The second is a registered company. A registered company is the one which is registered under the Companies Act 2013 or any of the earlier Companies Act, such as the 1956 Act or the earlier ones. Such companies come into existence when they are registered under the Companies Act and a certificate of incorporation is granted to them by the registrar. So this is the most common, the most used form of company that we use today. And whatever most of the part that we read in the company law is refers to this registered company only. So these are the two kinds of companies which can be classified on the basis of mode of incorporation. There is this another third kind of company, but we don't discuss it much because they are no more in existence. That is a chartered company. So the Crown, in exercise of the royal prerogative, has the power to create corporation by the grant of a charter to persons assenting to be incorporated. Such companies or corporations are known as chartered companies. So an example of this kind of company can be the East India Company, which was established in the year 1600. The powers and the nature of business of a chartered company are defined by the charter which incorporates it. After the country, that is India, attained independence, these types of companies do not exist in India, and therefore we do not read them. And therefore, I did not even mention this on the slide. But nevertheless, it is important for all of us to know what a chartered company is. So there can be the company can be classified on other bases as well. There are multiple miscellaneous kinds of company that we should know. So the other kind of companies include, the first one is a company is not for profit. This is a Section 8 company. So the Companies Act defines a Section 8 company as the one whose objective is to promote arts, commerce, science, research, education, sports, charity, social welfare, religion, environmental protection, or other similar objectives. These companies also apply their profit towards the furtherance of their cause and do not pay any dividend to their members. Reason being that they are not for profit. Now, these companies were previously defined under Section 25 of the 1956 Act with more or less the same provisions. So earlier we used to call them Section 25 companies. Now we call them Section 8 companies. But these are nothing but the companies which are not for profit. And most of the NGOs are also registered under the Section 8 of the Companies Act. The second kind of company is a foreign company. As already is mentioned in the slide, that Section 2, Clause 42 defines a foreign company as any company or body corporate which is incorporated outside India but has a place of business in India and conducts any business activity in India in any other manner. So it means a company which is incorporated outside India but has a place of business in India. The famous example of this can be any company. We have multiple MNCs these days. Most of them are foreign companies. The third one is a dormant company. This has been defined under Section 455. So a dormant company is the one which is formed and registered under the Companies Act for a future project or to hold an asset or intellectual property, but has no significant accounting transaction or is an inactive company. So irrespective of the object, what it has been established for, a dormant company is nothing but a sleeping company. That is, it has been registered, but it is actually not operating. So therefore, it is known as a dormant company. As the name of the, as the meaning of the word dormant itself suggests, that dormant means inactive. The fourth kind of a company is a government company. Now, a government company is the one in which not less than 51% paid up share capital is held singly or in combination with central government or one or more state governments. So, and the subsidiary of a government company is also a government company. So, all in all, a government company is the one which has the shares of which have been held by the central or the state government, and these shares should be more than 51%. The next form or the next kind of a company is a producer company. So a producer company is a body corporate having an object that is meant for the production, harvesting, procurement, grading, pooling, handling, marketing, selling, and the export of primary produce of the members or import of goods or services for their benefit. A lot of farmers register themselves as producer companies because their main business is producing at the ground level. So these are the producer companies. Next is an associate company. An associate company is the one in which the other company has a significant influence, and significant influence is not a vague word. It means control of at least 20% of the total voting power or of business decisions under an agreement. That is an associate company. Now, this one is important: a holding and a subsidiary company. A company that is owned and controlled by another company will be termed as subsidiary company, and the former is considered as a holding company. So there is a parent company, and then there is a this subsidiary company. The parent company holds the activities of the subsidiary company. The subsidiary company works under the holding company. Then comes small company. The section 2 clause 85 defines that a small company is new class of private limited company whose paid up share capital does not exceed 50 lakhs or turnover as per P&L account, that is the profit and loss account of the preceding financial year, and does not exceed 2 crore rupees. That is a small company. So these are the different kinds of companies that we read today. We classified the different forms of companies based upon different parameters. That was all from my side. I am Vandana